Ever looked at a bill and wondered why are there so many taxes? Before 2017, the world of Indian taxation was a bit like a jungle, chaotic, confusing and full of different pathways. If you were a business owner, you would have to deal with a tangle of different taxes at every single step. There was excise duty, service tax, VAT and so many others. It was a massive headache, and what made it worse, you were paying tax on a top of tax, a phenomenon we call the cascading effect. This made goods and services more expensive for everyone. Something had to change, and change it did. On 1st of July of 2017, the Goods and Service Tax or GST was introduced. It was a historical moment with one simple goal: to replace all those separate taxes with a single unified tax. The slogan said it all: one nation, one tax. Think of GST as a single comprehensive tax that is applied at every stage of the supply chain. From the manufacturer to the final consumer, it's a destination-based tax, which means the tax is ultimately collected in the state where the goods or service are consumed, not where they are produced. This single tax system made doing business simpler and more transparent. Now, even though it's one tax, it has a few different forms depending on where the transactions happen. Let's meet the three members of the GST family. First, we have CGST and SGST. They are two parts of a single transactions that take place when a sale happens within the same state. It's called interstate sale. For example, if a manufacturer in Delhi sells a product to a wholesaler in Delhi, a portion of the tax goes to the central government as CGST and the other portion goes to the Delhi state government as GST. It's called state GST. The tax amount is always split equally between them. Second, we have IGST. This is used when a sale happens between two different states. For example, if our manufacturer in Delhi sells to a retailer in Mumbai, only one tax is applied, IGST. It's called integrated GST. This tax is collected by the central government and they later distribute the SGST portion to the state of consumption, in this case Maharashtra. This is the most crucial part of GST and the reason why it eliminates the cascading effect. It's called the input tax credit or ITC. Think of ITC as a credit you get for the taxes you have already paid. Let's follow a simple biscuit packet to see how it works. Step 1. The biscuit manufacturer. The manufacturer buys raw materials like flour and sugar for say 100 rupees and pay 18% of GST on these materials, which is 18 rupees, and this 18 rupees is their input tax. Step 2. Selling to the wholesaler. This manufacturer now makes the biscuit and adds a value of 50 rupees. The total value now is 150. They sell this biscuit to a wholesaler and charge 18% GST on the new value, which is 27. This 27 rupees is their output tax. Now, for a magic, the manufacturer actual tax payment is not the full 27 rupees. They can claim back the 18 rupees they paid earlier as input tax credit. So, they only pay the difference, 27 rupees minus 18 rupees, which is just 9 rupees. This tax is paid only on the value added by the manufacturer. Step number 3. Selling to the retailer. The wholesaler buys a biscuit for 150 rupees and adds their own value, say 50 rupees. The price is now 200 rupees. They charge 18% of GST to the retailer, which is 36 rupees. Since they paid 27 rupees in tax earlier, they can claim that as their ITC. So their final tax payment is 36 rupees minus 27, which is also 9 rupees. Step number 4. Selling to the consumer. Finally, the retailer sells the biscuit to you, the consumer, of 250 rupees, adding their own value. They charge the final GST of 18%, which is 45 rupees. Since the consumer is in the final user, they cannot claim any ITC. They pay the full 45 rupees in tax. This genius of the system is that the full tax of 45 rupees is paid in bits and pieces by each business in the supply chain, but the tax is always calculated only on the value they have added. The final burden is only on the end consumer, just as intended. Part number 5. As part of a new reform, the GST system is being simplified. 22nd September of 2025, the multi-rate system will be replaced by a streamlined structure to make prices even more transparent. The 5% merit slab. This is for everyday items considered essential for the common person. This is a big win, as many items that were earlier taxed at higher rates have now been moved here. This includes personal care products like toothpaste, shampoo, packaged food, and butter and ghee, and medical equipment. Now, the 18% standard slab. This is now the default rate for most goods and services. Many products that were previously in the highest 28% slab have been moved to this bracket, including consumer durables like television televisions, air conditioners, and even small cars and motorcycles. The 0% nil rated slab remains in place for essentials like fresh vegetables, milks, certain life-saving medicines. It now also includes individual health and life insurance. A new 40% luxury sin slab has been introduced for items like high-end cars and certain luxury goods. This new simplified structure is designed to make prices fairer for the common person and encourage consumption. For businesses, GST has simplified compliance, reduced paperwork. For the government, it has increased tax collections, transparency, and for you, the consumer, it has eliminated the cascading effect that made the final price of goods more predictable. So, the next time you look at a bill, you will understand that the GST you are paying is part of a simplified, transparent system that has replaced the chaotic tax jungle of the past. It's a single tax that has streamlined the Indian economy.